but it becomes mathematical rather than just pundit based or debatable. It's simply going to end badly. So yeah, there's a hangover coming and there is no way out. I think the four-letter word that describes everything and what everything trickles down to is debt. How it will be sustained or not sustained, the mechanizations used to use lofty words to hide really, really bad math. And I think the lack of transparency and honesty about the ramifications of postponing a debt crisis with more debt, which is just monetized with literally money printed out of thin air that's not linked to an asset, a chaperone, or a service. And so all these things, from inflation to recession to quantitative easing, quantitative tightening, disinflation, currency risk, bond risk asset market risk, equity risk, it all flows down from debt, and debt all flows down from our policymakers, not just at the Fed, but globally, but in particular at the ECB, the Fed, the Bank of England, the Bank of Japan. It is phenomenally risky, and it's based on a monetary theory which I think has bought us some prosperity and some euphoria, but will end with a hell of a hangover. We've been enjoying years of a fantastic frat party provided by instant liquidity when needed, whenever there was a hiccup, and we've avoided any hangover by constantly providing Bloody Marys just as that hangover is starting to come. And I think a great movie title would be Hangover, because we're going to suffer a hell of a hangover. We've just been able to postpone it with optics and fiat money on demand and systemic liquidity, or excuse me, synthetic liquidity. And it's absolute fantasy, and it buys votes, it buys time, it even buys a Nobel Prize for Bernanke. It's absolute fiction to me. It's completely disingenuous and unsustainable. And again, it's not even tinfoil hat or sensational. We can get into the math of this. We'll talk about it, but the bond market is far more honest than a central banker or a politician, left, right, or center, or a governor of California or a mayor of Philadelphia or Chicago. The bond market is telling us what we want to hear. Unfortunately, the bond market is very boring. Looking at the implied volatility on the 2-year futures, or the yield on the 2-year or the 4-week treasury, or the 10-year long duration, no one wants to see this. I understand it's complicated, it's boring. It's actually fascinating when you look under it without too much complexity. I mean, a lot of people would rather watch Gwyneth Paltrow's trial about an ambulance chaser in Deer Valley because they don't want to see this, or they don't want to understand it. I understand how that's so boring, but it has massive ramifications for the quality of our life, and not just for political debate or pundit debate on different macro themes. It will and does hit the road. Eventually, it affects our lives. It affects our ability to take care of our families, to worry about our job security, to worry about our mortgages or our tuition. So these things seem esoteric and boring, and they need to be made less boring and more transparent, and not weaponized or partisan or political. It just needs to be simple math. And when we get into that, which I hope we will, I hope most of your viewers, obviously all your viewers, are very informed, but it becomes mathematical rather than just pundit based or debatable. It's simply going to end badly. So yeah, there's a hangover coming, and there is no way out. Reset, great reset, QE pivot, whatever you want to call it. It's going to need mouse click money to sustain our debt markets and to sustain our completely Fed driven equity and credit markets now. There's no natural price discovery. There's no natural supply and demand. The markets have been hijacked by a central bank years ago, and that's just what it is. The Fed actively manages our economy like a portfolio, but they're a bad portfolio manager. And they've bought time through leverage. They've bought time through lofty words and fancy diplomas and high position. But if history isn't canceled in 20 years, our kids or grandkids will read about the most epic failure of monetary policy since 1971, really, and certainly since 1913, when the Fed was unimmaculately conceived and brought into law under the pressure that Woodrow Wilson didn't even want to sign, by a bunch of banking cabals. So no, we're about to hit, serious karma. And, timing that is kind of a mug's game, but the math of it's fairly clear to me. There's been 3 moments of complete dysfunction in the credit markets, which, if people understood credit markets, should have been headline coffee talk news every day. And that repo market was the first. The 2020 sovereign crisis was the second. The gilt implosion was the third. That was last year. And then early this year, we've already come into the first quarter, and now we're seeing this Silicon Valley Bank narrative, the Silvergate, Signature, First Republic, et cetera. They're all related. They're all things that have broken. as we're raising rates into a debt bubble. When you raise the cost of debt, when debt is the rotten wind beneath the wings of this so-called post-2008 recovery, when you hit record high debt levels to sustain record high stock, bond, and real estate bubbles, and then when you hit that by keeping rates repressed for years and printing money to the tune of billions a month, when you reverse that policy, things start to break. And of course, something broke. We can talk about Silicon Valley Bank. To me, it's just a metaphor. It has nothing to do really with a 2008 parallel. It rhymes, but it's very different. But my point is, the Fed has put itself in a corner. They can either raise rates and destroy markets, banks, credit markets, equity markets. Equity markets follow the debt markets because equity markets depend on rolling over cheap debt and buying their own stocks at low rates. Those games are over in a rising rate environment. Powell has ended that charade. But at the same time as he's trying to fight inflation, he's going to get a Pyrrhic victory, looking over the rubble of credit markets, equity markets, and economies. And of course, smaller regional banks. But it really does have a ripple effect into the Main Street economy too, not just depositors at small banks. And so, something has broken. I think it's significant. It's more of a narrative about how year after year, headline after headline, another thing breaks because our bond markets are so vulnerable. And the Fed and the politicos, left or right, some more vociferous than others, will try to deny this with lofty words, kind of like be calm, carry on during the Blitz in London or World War II. Lots of lofty language to hide really, really dangerous math. Again, 31 trillion in public debt, 90 plus trillion in combined household, public, and corporate debt. That's become an aberration. And I said in that article, it's like Hannah Arendt's book, The Banality of Evil, talking about the Holocaust. When you're talking about millions of lives, it almost becomes a banalized, abstract. And even for the people at the time, they kind of turn their head, or even in history, it's hard to kind of conceive of those kind of numbers. As the joke, if I owe you $1 million, it's my problem. If I owe you $1 billion, it's nobody's problem. It's your problem because no one's going to pay it. These numbers become abstract. When you're talking about 31 trillion, and by the end of this year, probably 34 trillion in public debt, which we don't have the GDP or the tax receipts to pay for. And we'll have to monetize that debt by printing money in some form, in some way, mechanized, artificial. It's an abstraction. It's a banality of mathematical and debt evil. It's a banality of currency evil. It's a banality of trillions and billions that mean nothing to anyone anymore. They just kind of assume we have a debt ceiling, we have a bond crisis, we have an IOU. We'll pay for that with a mouse click at the Eccles building. That works only for so long until you see cracks in the ice. We've seen those prior cracks, the repo market, the gilt markets, now the regional banks. I think what we're seeing now is how many more cracks until the ice breaks beneath our feet and we have a bigger problem, which can only be solved by either some artificial reset, a global Chapter 11, or more likely, as Yellen's been hinting all of last year, despite Powell's chest puffing, a pause in the aggressive rate hikes and a return to the only solution we have, because Ponzi schemes can't taper. And that may sound like a massive simplification, but what we have as monetary policy, and this is something David Stockman said years ago, is effectively a Ponzi scheme. That's not an exaggeration. You can talk about Sam Bankman-Fried, or you can talk about Bernie Madoff, or you can talk about Bernanke, Powell, Yellen, and Greenspan, because what they do is they issue IOUs for which they don't have the money. We don't have the GDP, the tax receipts, the productivity, the income to pay for those IOUs. And when the proverbial X hits the fan, their last resort is always going to the Fed, mouse clicking a few extra zeros when needed to pay for those debts. Believe me, if Sam Bankman-Fried or Bernie Madoff or any sticky-fingered hedge fund manager who would otherwise be corruptly put in prison had a money printer in their basement, which they could legally use, they would use it. Who wouldn't? It's addictive. And, again, remember, Bernanke promised us back in 2010, QE1 was going to be temporary with no consequences. This is just a temporary solution for bank crisis. Just like Powell told us last year that, inflation was going to be temporary. They have to use words to deny the math. And again, this goes to the theme of who do you listen to? Do you listen to what Powell says, or do you listen to what the bond market says? When Powell raises rates, when rates go up, bond prices go down and yields go up. And that's what happened in Silicon Valley Bank. We won't get into the weeds of it, but basically their long duration treasuries lost value. Across the entire banking system, anyone holding long duration treasuries lost $2 trillion in market value on the collateral, those treasuries, which are considered risk-free return. But when measured against inflation, it's return-free risk. And so these policies, these measures by Powell have ramifications. They throttle the bond market, they throttle the banking market. But let's keep in mind also last year, 2022, all this talk about what a brave Volcker reborn superstar Powell is going to be. Remember, Volcker raised rates in the 80s or late 70s when our national debt was less than $1 trillion. It was 800 billion, 900 billion at the hot. We're at 31 trillion. So we can't afford to raise the cost of that debt when our debt is infinitely higher than it was in the Volcker era. So for Powell to pretend to be Volcker is frankly disingenuous. So we're talking about math that doesn't make sense if you just look at the simple balance sheets. And what did Powell achieve? He reduced the balance sheet by 300 billion. After all that talk last year, all this QT that so shocked the markets, the S&P, the NASDAQ, the credit markets got shellacked last year. S&P down 15, the tech, NASDAQ down 30%, credit markets down. We had the worst nominal returns in stocks and bonds in 2020 nominal together. These are correlated assets. They're supposed to be hedged. They're correlated now. Stocks and bonds, worst nominal return since 1871, just past our Civil War. So that proved that that little reduction in the balance sheet, which was 300 billion, which by the way, just in the last few weeks, we've already lost that 300 billion in loans to these regional banks and FDIC extensions. So all the work that we got for QT last year, well, we saw the reaction in the bond and stock market. A 2% reduction in the Fed balance sheet caused massive ripple effects in our credit and equity markets. And frankly, all the quote unquote money that we tightened is already back in the system. So there is a major thirst for liquidity, a major thirst for collateral in the banks, a major need to support the treasury market naturally. It can't be done naturally. There is no natural demand for Uncle Sam's unloved IOUs. And so regardless of what Powell does this quarter or last quarter, regardless of what the FOMC meetings or the Brookings Institute or even what they say in Jackson Hole, the net result is if no one else is buying our debt, who's going to buy it? It's simple, but it's going to have to be a central bank near you. And again, if we don't, the consequences are going to be dramatic in our economy. They're already dramatic in our banking system. But if we do pivot and instantly liquidify the treasury markets and therefore the banking markets, the bond markets, the repo markets, the Eurodollar markets, all these different exchanges, even the derivative markets for which treasuries are collateral, all these things rely on liquid treasuries. If we liquidify them through mouse click money, we have the inevitable inflation or possibly hyperinflation. People talk about inflation. You know, there are real issues about the war, about COVID, about supply chain links, but let's just keep it simple, stupid. We raised the M2 money supply by 14 trillion over the last decade plus. That's why we have inflation. It's very simple. If I hand you a glass of good Bordeaux wine and we put a swimming pool of money into that glass of wine, you know, the wine loses its flavor, just like our currency has lost its punch. It may be relatively stronger than all the other patients in the ICU. It's still a sick patient. It's still the inherent purchasing power of that currency, like every other currency, has lost so much value when measured against real assets that it's openly obvious. And again, these things are not transparently discussed, Adam. These are boring things about currency risk, about yields on bonds, about supporting those bonds through printed money or mouse click money. How much is 31 trillion versus 35 trillion or 900, a $9 trillion Fed balance sheet versus a $4 trillion balance sheet? There's abstractions. And if you saw Yellen recently in front of the Senate, it was embarrassing. I was almost embarrassed for Yellen, how little she understood about the extension of the deficit, the rising of the deficit this year. She didn't even have the numbers in front of her, and she's the Treasury Secretary and a former Fed chair. So again, when push comes to shove, when you're asked to look at hard numbers, even our experts don't even fully grasp them. And certainly the average person, through no fault of their own, has, I think, less and less understanding. I think more and more so now, hopefully. But for years it was just trust the experts. I think that trust, like trust in just about everything, whether it's the media, politics, social identity politics, partisan politics, left versus right media, trust in so many things is palpably changing right now in the U.S. and certainly here in Europe. It's a major loss of trust, and that also has invisible, hard to quantify ramifications too.